There's a popular saying in leadership that if you think you're leading and there's nobody following you, you are only going on a walk. On this platform, you are going to learn principles of leadership. You are going to encounter different leaders. You are going to learn about how you can grow as a leader, how you can make an impact. My name is Samuel Eyim, and I'm the host for the leadership platform. I am a leadership coach, a lawyer by profession, a John C. Maxwell certified coach. I have been in corporate life in senior positions for several years, and now I run the Center for Transformational Leadership, where we train and coach leaders to become better leaders. And I invite you to go on a journey with us as we discuss the subject of leadership in the coming weeks.
This and every Saturday, you have opportunity to ask questions, share your views on important leadership matters.
Hi dear friend, my name is Samuel Eyim, and I'm the CEO for the Center for Transformational Leadership. And I'm bringing to you the growth journey. We've set aside 15 weeks of growth to help you to be intentional about your growth. Where do you want to reach in your leadership? Which area of your life do you want to grow in? Growth doesn't just happen. It has to be intentional. So in these 15 weeks, we're going to have a special coaching sessions with you to be able to grow to where you want to grow. And to be able to grow yourself, you need to know yourself. A lot of us are not achieving the maximum we can achieve because we have not invested in our personal growth. We're going to help you in all and more within these 15 weeks. Every week we'll have a session with you. This program is limited to only 15 people. We're going to have 15 people for 15 weeks, and we're going to learn 15 great growth lessons on this journey. So make a date with us and see you on the growth journey.
Hello. Good evening, everyone, and welcome to the Leadership Platform. My name is Samuel Eyim, and I'm excited this evening, every Saturday evening, when I come to learn from all of you, and more importantly, when I meet all of you who are ready to learn and to grow in your leadership. And our promise every Saturday is that we're going to bring you a topic of relevance to leaders, and we are going to bring you the best possible speaker on the subject. So this evening, we are excited to have all of you, and we encourage you at this moment, if you're connected on Facebook or YouTube, please go ahead and introduce yourself. Let us know where you are calling from. Just give us your name and where you're connecting from. It is always a joy and pleasure to introduce you to the world that you are on the leadership platform. Also, please share the link with your friends, your leaders in your churches, in your businesses, your bosses, because this is going to be a very important discussion this evening. Subscribe to our YouTube channel, like our Facebook page, and generally give us your comments and your feedback. We are going to be together for an hour and a half, and I encourage you to stay to the end, because usually the greatest lessons come in during the interaction sessions, during the questions and answers. And please, we encourage you, go ahead, share your thoughts on the subject, share your comments, ask your questions. There is no stupid question. The only stupid question is the one that you don't ask, you keep into yourself, and then you regret later on. So go ahead and introduce yourself, and we'll be happy to share with you. The team is ready. Kofi is ready. Sarah is here with us. Abigail is here. And I believe that Diana and all the others are all connected also to support you on Facebook, on YouTube. And so you are welcome. This evening, we have a very important subject. And for those of us in Ghana in particular, you know that there's been so much discussion about taxes. Now, several businesses have suffered big penalties because they did not understand their tax obligations. Leaders and professionals have, lost business and contracts because they failed to pay taxes. In fact, some people are in prison because they failed in their tax obligation. As leaders, we are supposed to know better, and that is why this evening we are bringing you the tax fundamentals that all leaders need to know. Of course, this is a very big subject and a very deep subject, so the time allotted is not enough. But as we say always, the professional who is going to discuss with us has lots of services available for those of you, the business leaders, who may need professional service on tax and the other things. Please, the speaker will be happy to help you. So let me just quickly introduce our speaker, and we've shared his profile. So go on our website and you'll see Dr. Abdallah Ali Nakyea is very, very well known. He is a senior lecturer of the University of Ghana. He lectures in law. He has over 28 years of extensive experience in several professional fields, including taxation, accounting, auditing, and law. He holds a BA in economics with philosophy, MPhil in economics, post first degree Bachelor of Laws, all from the University of Ghana. He has a qualifying certificate for the practice of law from the University of Ghana. He also holds a PhD in tax policy from University of Pretoria. And I'm just going to say this and I'll stop, because there's so much about Dr. Nakyea that we can say. But he's a member of the Ghana Bar Association, of the Institute of Chartered Accountants Ghana, of the Institute of Internal Auditors Ghana, the South African Institute of Tax Professionals, and a fellow of the Chartered Institute of Taxation Ghana. So, I mean, there's so much we can say, but he's written on the on the subject of tax. He's taught tax and business and law and all, and he is also a consultant in these fields, in law, in accounting, in audit, in tax, and so on. So Doc is very, very, very highly demanded, and so we are privileged and in fact honored to have Doc on the platform. And I will introduce him to take over. And guys, I would introduce all of you later on as we go ahead. So Doc, you are very welcome to the leadership platform, and we thank you.
Thank you very much, Senior. I'm most grateful to be part of your Progressive Leadership Forum. And I'm grateful for the opportunity to also share the little that I know and what will help business leaders to be up and doing with their taxes, so they avoid any penalties and any of the sanctions that you mentioned can befall them. May I know if they can now get my slides to project on the screen? Okay, thank you very much. To know that when we talk of a tax, what is it all about? There is the confusion whether levies are taxes, whether road tolls are taxes. But that has been made very easy for us because if you take our Revenue Administration Act, it clearly tells us that a tax includes a duty, a levy, a charge, a rate. In fact, any other amounts that the Commissioner General may be empowered under a tax law to collect. So thankfully, with our Revenue Administration Act, we don't need to struggle to understand whether a payment is a tax or not. And also because of the debate as to why should we be paying taxes, the question is that taxation plays a lot of roles in an economy. Aside raising money, it will also help us in trying to stabilize the economy. Two things that cause a lot of stability in an economy is inflation and unemployment. So in times when there are high inflation figures, government always comes in to try to look at how to reduce the inflation by way of looking at the taxes that can reduce the disposable income in the hands of persons. If it wants to grow the economy, you lower the taxes, and then businesses can have more earnings reserved to be able to expand, create jobs, and all that you have. We also use taxes to redistribute resources in the economy by giving tax incentives when people locate in certain sectors of the economy. We can also use it to reallocate resources as also as a fiscal tool. We can use it to control our debt situation if people are importing too much so that our exchange rate is deteriorating. We can use taxes to deal with it. And taxes can also be used to influence behavior. If it comes to people consuming alcohol and tobacco, giving health problems and health bills of an economy going up, the government may wish to reduce the spending and consumption of such harmful goods, and that will require taxes to be increased on them. So these are, in brief, some of the rationale that we have. But there are principles that guide tax policy. We say that a tax policy should be neutral in the sense that it should be equitable and not distort the market. And also inefficiency, the tax system should be such that compliance would be very easy for people, and that is when the tax handle can bring in the needed revenue for which government imposed it. There should also be the issue of certainty and simplicity. It is only when people understand and can apply and comply with the tax law that we are able to get meaningful collection of tax revenue. So it's one of the principles of tax policy, whether we can make the tax very simple to understand so people can comply, and also in certainty, people should know exactly what give rise to what type of tax. And then also there's the issue of effectiveness and fairness in terms of the collection and the application of the tax to the citizenry. Then there is the issue of equity that every tax policy also looks at. Can it be said that people who, based on the benefit principle, the one who benefits more from services from government should also be able to pay more, as against the ability to pay approach, which also looks at the fact that if people have the ability to pay, they should pay more than those who do not have the ability. And that is the area of equity, as in fairness of a tax system. And then also the fact that a tax system must have flexibility. It should be able to grow along with the growth in the economy, such as you can see, once the government sees that there is growth in mobile money, government thinks, let's look at what we can get from the mobile money sector. It's one of the areas that is accounting for this policy direction. Now, in all jurisdictions, it is a fact that tax is a creature of statute, in that where the law does not impose the tax, then you cannot collect it, and people will not be willing to comply. And if you come to Ghana under Article 1741 of our Constitution, it is clearly stated that No tax shall be imposed otherwise by or under the authority of an act of parliament. So you realize that all our taxes are backed by laws that have emanated from parliament. The Income Tax Act 2015 Act 896. We have the Value Added Tax Act 2013 Act 870. We can talk of the Customs Act also 2015. We have the Revenue Administration Act of 2016, Act 915. And they all come with what we call regulations that would give better understanding of what the law seeks to provide. Taxes generally are classified into two: direct taxes and indirect. Direct taxes are the taxes that are imposed on incomes, and they are called direct because the impact and incidence is on the same person. Example, corporate tax, personal income tax, capital gains tax, gift tax. These are on your income. So when you earn that income and you pay, you feel the pinch of the payment. Whereas indirect taxes get to your income not directly, but through your purchase of goods and services. And so they are normally taxes that you find on goods and services, such as the Value Added Tax Act, VAT. We can talk about the Ghana Education Trust Fund levy. We can talk about COVID-19 health recovery levy, the National Health Insurance levy, import duties that we pay on goods at the port, excise duties paid on locally manufactured goods, and also some import items. These are the indirect taxes that we have in our system. And if you come to taxation of income, there are three main sources of income that our tax law pays attention to when it comes to direct taxes. And these are income from employment, from business, and from investment. And so when you earn income as an employee, your employer is required by law to deduct tax, pay as you earn, and give it to the Ghana Revenue Authority. If you are in business, you earn income, then you have certain deductions you can make from the income, and the profit that is left is adjusted by way of whatever reliefs or capital allowances you can get. And then when the chargeable income is arrived at, the tax will be levied on it. And so we'll take you a bit through what is chargeable income and what is assessable income. Then we have investment income, which is also income that you earn from dividend, from interest, from rent, and such other sources. Now, when we talk about chargeable income, it is the income of a person that will be subjected to tax. So it is the total assessable income of a person that has been earned from either employment, business, or investment. And after deductions have been made, which deductions are allowable deductions provided for under the income tax law. For example, if you're an employee, you may get the personal reliefs, or if you are self-employed, all the reliefs will be granted, and what is left is what becomes your chargeable income. So your assessable income is your total income from the three sources of income before any deductions are made. And it is necessary to also note that in determining one's income, either from business, investment, or employment, they are determined separately. You don't combine them as we used to have under the Internal Revenue Act 2000 at 592. So as I indicated, if you are an employee or you are self-employed, there are reliefs that are available to you under the Income Tax Act, and that is under the fifth schedule, where you have to look at if you have a dependent relative, you have 1,200 a year to deduct before we arrive at your income for tax purposes. If you are disabled, you are entitled to 25% of your assessable income as a relief before you pay tax. If you are aged, you also have a relief. And if you have dependents, aged dependents, by way of taking care of maybe your father, your mother, then you are entitled to a deduction of 1,000 per person, so up to a maximum of 2. And then if you are taking care of children in school, you are entitled to education relief. And so these are some of the reliefs that as business leaders, we should be mindful of, because if we grant it to our employees, it it's able to help them get a bigger take-home pay because the tax rate is lowered, and then they are able to have a better take-home, and agitations for maybe salary increases may be reduced. Then also we have a provision in the law under the regulations dealing with taxation of bonuses and overtime, so that if a junior employee earns an overtime, because the law says that these concessionary rates are available to only junior qualifying employees who the law has defined to be employees who earn not more than 18,000 Ghana cedis a year. And so if they earn any overtime, then the law is looking at the fact that if the overtime does not exceed 50% of their salary, they get a lower tax to pay on it. And this is a final tax. They are not liable to pay any tax on that overtime again. And if it exceeds 50% of their salary, then they will be taxed at 10% as a flat rate. And for all employees who are given bonuses, the law provides that if the bonus does not exceed 15% of your annual salary, you pay a final tax of 5%. And then the net is not subject to tax again. So if you earn any bonus exceeding 15% of your annual salary, up to 15% will be taxed at 5%. Any excess will then be added to your income and subjected to the graduated rate. And if you are provided a benefit in kind as an employee, there are two types. Either you are provided with a vehicle, and the vehicle you are given a driver, or it is fuel. In all the categories, the law has provided the quantification of that benefit for tax purposes. So if you have a driver with vehicle and the fuel is also given, then 12.5% of your total cash emoluments would be determined, but it is limited to a maximum of 600 Ghana cedis per month. And then if it is a vehicle with fuel, it's also 10%, but not exceeding 500 per month. Vehicle only 5%, not exceeding 250, and then same for fuel. And so these are the areas where if we do not pay attention as leaders, we may be paying and providing these without adding it to the tax exposure of the employee. And when there is a tax audit, then it gives you an exposure with the attendant penalties and interest. The other benefit is the provision of accommodation, what is known as rent element. So if the accommodation is furnished, then it's going to be 10% of your total cash emolument. Interestingly, under rent element, there is no restriction as we have in the case of the provision of vehicles. If it's accommodation given to you and you have to furnish it, it's 7.5% of your total cash emoluments that will be added. If you have your accommodation and the company provides you with furnishing, then it's going to be 2.5%. And if you are sharing the accommodation with another employee, it's also going to be 2.5%. There is also the issue of payment to casual workers. The regulation provides that they should be taxed at a 5% flat on the gross income. It's a final tax. They are not liable to any tax again. And a casual worker takes this definition from the Labor Act, which says that a person who is given intermittent employment not exceeding 6 months. So if it exceeds 6 months, then the person rather becomes a temporary worker who is treated just like any permanent worker, meaning the salary is taxed at the graduated rate as any permanent employee. Another tax that is direct that we have to be mindful of is capital gains tax and gift tax. Capital gains, when you realize a chargeable asset, which could be a land, your building, a vehicle, all those, when you realize them, if you are an individual, you are likely to pay 15% on the gains that you made. So the amount you received will be reduced by the cost base. That is what you incurred in acquiring that asset, and any cost incurred in realizing it, and any cost in maintaining it up to the time of the disposal. They will all be deducted, and the gains will be taxed at 15% for an individual. If you're a company, it is added to the corporate income for tax purposes, meaning a company can go up to 25% tax on capital gains. Then when it comes to gifts, when you receive a gift, you are required to pay tax on it. Again, an individual is at 15%. A company, a business that receives the gift is to add it to its income, and the corporate tax rate would apply. A gift is seen as a receipt for which there is no consideration or there is inadequate consideration. I think a lot of people just had gifts passing hands sometime 14 February, not too long ago. Somebody will say the value in the old law, a value was placed on how much that will be taxed. But this time, I don't think the evaluation happens again. So whether it was a box of chocolate, we need to value it and pay the tax on it. Another area as business leaders we need to be mindful of, which gives us a lot of tax exposure, is the area of withholding tax. The Commissioner General makes all of us withholding tax agents by virtue of the provisions in sections 114, 115, and 116 of the Income Tax Act 2015, Act 896. And what that means is that when you are making payment to a person for the supply of goods or services or renting of a property, the Commissioner General has given rates that you should apply on the payment and give it to him. Where you withhold, some of them are final taxes. For example, when you are deducting withholding tax on rent, if it's residential accommodation is 8%, commercial 15%, they are final taxes, which means the person is not liable to tax on that income again. When we say a withholding tax is a payment on account, then it means it's an advance payment of your tax liability. So at the end of the day, there will be an estimation of your actual tax liability. What you paid upfront will be credited to you, and when there is a difference, you make a top-up. If you have overpaid, you are entitled to a refund. So as business leaders, it is not only the case that we have to be paying taxes. We may be entitled to a refund if we keep good records which are available for a tax audit and confirmation. We are going to be entitled to a refund. Then under the withholding taxes, as I mentioned, employers are required to withhold taxes from payments to employees under Section 114. And then on investment income is Section 115. And then for the withholding tax on goods, services, and payment of service fees is under Section 116 of the Income Tax Act, which we can refer to. So here I've provided a table which will help in looking at the withholding taxes on investment returns. If you pay anybody dividend for holding shares in your company, the withholding tax is 8%. If it is interest, it's also 8%. And I mentioned also that if it is rent and it's residential, it's 8%. If it's commercial, then it is 15%. And if it's a payment for royalties, then it's also 15%. Then we also have contract payments that we make for non-residents is at 20%. And we are saying that if you are making payments as a business leader with your company or business, you are paying fees to directors, allowances to board members, then you should know the withholding tax is 20%. For those who are in lecturing part-time, you could be a business leader, you have a part-time appointment to teach at the university, then you will be suffering a 10% withholding tax. Commissions are also 10%, so we have the table for you with the tax rates that once the slides are shared, it will be a guidance. Service fees to non-residents is at 20%, and then we also have the payment for non-resident insurance companies. Then we have the internal or resident payments we make. 3% when you are paying the person, and then when works are being provided to you and you are paying the person, the rate is 5%. Supply of goods and services is at 7.5% withholding tax. For non-residents, management and technical service fee and supply of goods and services is at 20%. And so if you do not comply with these withholding tax rules, the Commissioner General is also given the power to surcharge you with the amount of tax that you should have withheld and brought to the Ghana Revenue Authority. And that would give you a lot of liability. Although under the law, you have also got the power to claim it from the person that was supposed to have suffered it. But why would you want to incur a liability in the first place, which will come with only not the surcharge, but also interest and penalties for failing to apply the law? So these are what we need to avoid if we need to get it right. Aside the taxes we've discussed, which are based on direct taxes, the major indirect tax component is the value-added tax, which is also collected along with the National Health Insurance Levy, and then the Ghana Education Trust Fund Levy and COVID-19 Health Recovery Levy, because they have their separate laws, all right, but under the Value-Added Tax Act, it is to be collected by the Ghana Revenue Authority along with any value-added tax. So that is how it operates. And then we have the standard rate of VAT, which is 12.5%, which is to be paid or charged on the supply of goods and services. And then we have the VAT flat rate, which is at 3% for retailers who have a turnover of 500,000 and below. And then we also have the rates that are charged along with the value-added tax, which are the straight levies. They are charged on the value of goods or service before the VAT will be applied on it. So there is that cascading effect of the tax. So National Health Insurance is 2.5%, Get Fund Levy is 2.5%, and then COVID recovery levy is also 1%. So these three are charged on the value of goods and services added to that value, and then the VAT is slammed on it. And this is how the demonstration is. So you have the invoice value at 100 cedis. There is National Health Insurance Levy of 2.5% on it, and then the Get Fund 2.5%, and then COVID levy 1%. So when you add that, you get 106, and then the VAT of 12.5% is charged on it. So that is how it is done. But when the person has issued an invoice like this and you are to withhold, you are to withhold on the invoice value of the 100, not on the total value. Else you will be withholding on the VAT. But then the Commissioner General has only given power to certain businesses that are required to withhold 7% on VAT and pay over to him. If you are not in that category, you cannot do a VAT withholding. And for those that are on the VAT flat rate, it operates as 3% on the invoice value of 100, and then the COVID levy of 1% is added, and you get the total invoice value. Now, having had a basic understanding of the direct taxes and indirect taxes in brief, we want to look at how we can plan in managing our taxes. That is the crux of the discussion for this evening. So what you can do in managing your taxes to stay out of trouble is to be able to plan your tax affairs. And tax planning is all about arranging your affairs in accordance with the law so that you pay the minimum tax possible. Indeed, if arrangement according to the law would end up with you not paying any tax at all, then that is a good riddance. But in trying to go about avoiding taxes, you need to also be mindful that there are anti-avoidance provisions in the tax law, because some incentives that you may be claiming are not meant for you, or you do not meet the criteria to qualify for it. If you go ahead and take it on a tax audit, this avoidance would have landed you in an evasion. And that is what my learned senior, Mr. Kwame Ejejan, will refer to as tax avoidance. You intended to avoid and you ended up evading. So what are the tax planning strategies? We say that every tax planning strategy would involve financial implications. So you need to appreciate your financial plan to determine what would be the impact of the tax planning on your financial decision. Remember, taxation will only guide you to plan your financials, but it shouldn't be, because at the end of the day, if the financial plan can give you enough profit, taxes are on profit. So if you can make the profit pay your tax and still have a big bottom line, then don't worry yourself about going ahead and not doing too much tax planning. But then you also want to be sure that it does make economic sense. That's the next priority. And then you have to examine what is the potential benefit of planning your taxes in that way. So the impact of tax planning has to be looked at in various sectors. As business leaders, one of our biggest challenges has to do with working capital, the amount of money that we need for our day-to-day operations, which will end up with a profit or a loss at the end of the year. And so if we arrange our affairs affecting our day-to-day management, we would end up having a better bottom line, avoiding any tax penalties and interest. For example, what does it take? What is the tax implication of your inventory holding policy? Do you pay import duty and VAT on all your items only to come and put them in stores? You've locked up your capital in the warehouse. So the idea is that why don't you weigh the options to see how much would it cost you to keep the goods in a bonded warehouse? Because once they are going into the bonded warehouse, taxes and duties are suspended. They are paid when the goods leave the bonded warehouse. Are you able to plan so that you don't lock up your capital by way of taxes and duties upfront? What is your receivables collection policy? Do you give people too long a term to repay you as against your creditor payment policy? If you do that, you are locking up your working capital, because people will be chasing you for the items they've supplied to you. You don't have the money because your debtors have not paid you. Question is, how did you arrange that? And remember that there will be withholding tax implications on your receivables as well. You need to also look at your short-term loans. What are the interest rate? And shareholder loans also have tax implications because of thin capitalization. There is a rule that says that where you have exceeded a thin capitalization ratio of a debt equity of 3:1, then the Ghana Revenue Authority will restrict the interest that you are charging in your financial statements to that ratio. So supposing the interest you are paying on a debt gives you a debt equity ratio of 10:1, you can imagine the tax exposure you are giving yourself, because all the interest that will be disallowed is going to be added to your income and taxes imposed on that. So that is how you look at it in the working capital scenario of tax planning. When it even comes to asset acquisition, you need to look at your policy. Are you buying the asset or you are leasing? Because lease rentals are allowable deductions against your profit. But if you buy, you are entitled to capital allowance. You need to weigh the options. Which one gives me a lower tax liability? Which one gives me a better profit bottom line? And you don't only look at the tax implication, you also find out whether it makes economic sense. Do you have the financial wherewithal to be meeting the lease rental payments? If not, then don't go and tie yourself in a lease rental just because of a tax benefit. The timing of acquisition of assets is also critical, because if you buy an asset and it is not in use at the end of the basis period, meaning at the end of the year that your taxes are going to be assessed, then you don't qualify for capital allowance. So why do you sell off assets when it's close to the end of the year? That is the time you rather need them to be there to get the capital allowance. So there is a policy that why don't you even buy late at the end of the year? And if you want to sell, better sell it early in the year. Because if you have it throughout the year, you would have charged all the depreciation, which will be disallowed for tax purposes. Yet the asset is not there to qualify for capital allowance to offset the add backs to your profit that is going to give you a high tax liability. Also, if it comes to dividend payment strategy, we need to know a lot of business leaders have related companies. And there is this provision in Section 59, subsection 3 of Act 896, the Income Tax Act, which says that where dividend is being paid by one resident company to another resident company, which controls directly or indirectly 25% or more of the voting rights of the company paying the dividend, then there is no withholding tax. There is an exemption on withholding tax. So as business leaders, we need to look at the structure of businesses we have, especially those that have related companies or group companies that they've invested in. If you take most of the businesses, we have Zoom Lion with all its affiliates, it may be holding 25% or more in other related parties. So when the dividends are being paid, then they are exempt. If we take Kina Pharma, we may have them having other lines of businesses, either a hotel or, and then you can take Champion. Champion may have filling station, may have hotels. The question is if the dividends are being paid from one to the other, and there is this threshold you meet, you need not suffer that tax. But if you don't know, of course, you would have suffered the tax. And then also you have to note that this provision is available when the shares you are holding by 25% or more are ordinary shares. They don't cover preference shares. So we need to be mindful of that. Now, in trying to be careful with your taxes, there are two key things that you need to be mindful of. We have tax avoidance and tax evasion. Very tricky, because these are the two main sources people use to avoid payment of taxes, except tax evasion is illegal, but tax avoidance is legal. Legal because you are only arranging your affairs in accordance with the law. As Professor Whitcroft mentioned, that tax avoidance is the art of dodging tax without breaking the law. You are dodging tax because you are paying less than you are supposed to pay. You are not breaking the law because the law has given you the opportunity to take advantage of such. And for example, you want to set up a manufacturing company to process fruit juice, and all your supply of fruit juice will be found around, let's say, Dobro area, Amasamai. Why would you then put up the factory in Tema? Why don't you locate? Because that will be Garura, and then you will be entitled to a location incentive of paying 12.5% corporate tax instead of 25%. So you have dodged paying 25%, but you've not broken the law, because it's the law that has given you the location incentive. If you don't have money to acquire a car and get a driver to be doing dispatch for you, what stops you from having an arrangement with a courier company and be paying them either monthly or as and when they pick a parcel from your office for delivery? You would have charged the payment to the courier service as an expense. You will withhold the tax of 7.5%, give it to the government. You save yourself repairs and maintenance of a vehicle, salaries of a driver, social security contribution of the driver. So that is all about tax planning. How do I arrange my affairs to pay the minimum tax possible? So with tax avoidance, as we mentioned, you can be successful in avoiding taxes legitimately if the tax law does not provide ways of checking you in undertaking an otherwise what we call aggressive tax avoidance. Aggressive because you want to take undue advantage of the law and set up structures that would benefit. Now, remember that under Section 34, subsection 2, the Commissioner General has the power, when he sees any such arrangement, to recharacterize the arrangement you've done and subject you to tax because you are not the person for which those incentives were provided. And so we need to be mindful of Section 34 of the Income Tax Act, Act 896, and looking at the arrangement the Commissioner General is referring to. Where there is any arrangement, one of its purpose is to reduce your tax liability, he can always recharacterize your transaction, especially when the substance does not reflect the form. Then it becomes a facade. So that is what I want you to be looking at when you are thinking about tax avoidance. So remember also that, as I indicated, it's about the misuse of or the abuse of the tax law provisions which would empower the Commissioner General to invoke Section 34. So if what you are doing has economic substance and the substance reflects the form, you can be free to go ahead if it even leads to tax avoidance scheme, because then you have justification, and I don't think the Commissioner General would overstretch the provisions of Section 34. Tax evasion, we've indicated that it is illegal because it is not an acceptable behavior, because you are deliberately refusing to pay tax. You are using subterfuge. You are doing a whole lot of things which are listed below. For example, you are keeping separate books of account. There is one you show to the GRA, which is different from the one you show to the bank when you want a loan. I don't think business leaders will get ourselves involved in this. And so that is one of the areas. And then people may also not declare certain transactions they've gone into, and by so doing under declare the income. Some go into barter trade. Well, as a lawyer, please, can you handle my cases for me, and I'll provide you accommodation to use as your offices. So here you are, the lawyer will not pay rent, and so government loses the rent tax, 15% commercial the lawyer would have charged from you, and then you also go scot-free without charging 7.5% on payments to the lawyer for the provision of the legal services. So barter trade is one area that is not conducive for business because it's illegal in terms of tax. And then we also have the issue of overstating of expenses, where people undertake private travels, private endeavors. And as you would remember, the issue that happened in South Africa between South African Revenue Service and the Gupta family, for example, where weddings and family birthday parties are charged to the company accounts. These are some of the overstating of expenses that as business leaders we need to avoid. If we need to have private expenses, they should come from our profits that we have earned. Now, what are the ingredients that you need in heading towards a conclusion? Let's see what we can arm you in trying to do an effective tax planning. One, you should be able to interpret the tax legislation. And here, if you are not able to do that, you have a plethora of business professionals you can go to. Chartered accountants are there, the lawyers are there, the Chartered Institute of Taxation practitioners are there to guide you to understand the provision of the tax legislation. And then you should also build capacity in trying to identify the opportunities in the tax law. I mentioned location incentives, for example. How many of us know that if you recruit fresh graduates into your business, you're entitled to a deduction in addition to their salaries, a percentage depending on their proportion to your workforce? These are all incentives available in the tax law. Knowledge of reliefs granted by the law. We went through personal reliefs. How many of us are claiming the personal reliefs? Marriage relief, children's education, no matter how meager it is, it goes to reduce your tax liability. And then after you've even identified, how are you able to apply the planning schemes? If you know it and you can't apply it, it's as good as you did not know. Then also the knowledge of the attitude or reaction of the Ghana Revenue Authority and its officials, because there are some issues that they may also not have been well versed in it. It requires a lot of discussion with them for them to appreciate the angle you are coming from. Else, for on the face of it, they may want to disallow it, but you need to prove where you are coming from and how you are looking at it. And then also the attitude of our courts, because now we have a lot of tax courts that are helping in developing tax law and also assisting both the Ghana Revenue Authority in mobilizing resources from recalcitrant taxpayers, and also findings are being made for taxpayers who have made it a case against the GRA and the court has held that they have a case. So those can go either way, and so we need to be mindful that where we disagree, the GRA disagrees, we need to interpret, we have to have recourse to the court. It does not change anything. And remember, we now have also the criminal tax court to prosecute recalcitrant taxpayers. And that is why this discussion by this platform is very important. So we try to stay out of the troubles. Then what would you need if you want to do a proper tax management scheme? You have to keep proper books of accounts to avoid penalties. Always make sure your accountants, your auditors assist you in this regard. Accounts and relevant records must be kept, because in any audit by the Ghana Revenue Authority, they want to see the source document, and there shouldn't be anything to hide. Make it available truthfully. Let them confirm, because in the event that you don't have supporting document, they will not allow you a deduction for certain expenses which will otherwise be genuine. Submit regular annual returns, because failure to file returns on due dates is an offense and it comes with penalties. So when you have to lodge objections, you need to do so within statutory time limits, because when the time for objection lapses, it is not acceptable. You've been caught by the law. And also make sure you pay taxes on time. If there is any cause of delay, you better need to arrange with your tax office at the GRA and then explain matters. They may give you a leeway, a week, 2, a month, and also be able to give you the necessary assistance on how you can schedule your payment terms. And also try to arrange acceptable basis period. Basis period is the years whose income you are being assessed. So if you prepare January to December, a company cannot keep any other period other than the basis period. An individual, you can't keep any basis period other than January to December. But a company can arrange to have its accounts prepared from July of one year to June of the other year, February of one year to January of another year. These are the basis period you can always discuss. You need to also hold regular discussions with your advisors, especially at the budgeting stage where you plan to incur certain expenditure. That is when they can point out the possible exposures, and then you would make sure you cover it. And also try and conduct self-audits. You don't need to always wait for the Ghana Revenue Authority to come and audit you. You can, of your own, get your auditors, your advisors to do a tax health check to know where you are doing right, where you are going wrong, and then you can pay up whatever exposures before the revenue comes. When you are able to detect yourself and make the payments, you absolve yourself of penalties and interest. And maybe you may have refunds, and then you can claim it. And so these are the areas of expenditure that are allowable for deduction as a businessman. And so we need to keep proper records. If you have bad debts, you have to keep records showing the efforts you've made to recover without success. If you have capital allowances, you need to have a schedule of your assets that qualify for it. So this will guide you in knowing which expenses are available to you. So in summary and the recommendations, I would say that always draw a line between tax avoidance and tax evasion, because with evasion being illegal, your penalties and interest and the effect on your business being closed down may be too devastating. When it comes to business objectives, we are saying that first try to check the suitability of your decision, look at the economic fundamentals, and make the tax consideration the third. Don't ever make it the first, because if you can make the money and pay the tax and still have enough on you, then of course, you don't strain yourself to say, I won't buy the asset, I'll lease because I'll get a benefit from the lease. The question is, how significant is that benefit? And also remember, tax planning is a process. It's not an event. So what you plan today, tomorrow you may have to review it, because it may not be in good state, because the tax laws keep changing. And then the position could have changed in respect of the decision you took. And also keep proper books of accounts. So in conclusion, always keep proper books of accounts. Make sure that your accounts have the supporting documentation. You submit your regular monthly, quarterly, and annual returns, and also make payments on due dates. Make sure you build your capacity in understanding and interpreting the tax law. And if you can't, you have recourse to your advisors, be it your accountants, your auditors, your tax advisors, and your lawyers. Thank you very much for your attention. And then we are most grateful for your participation. Thank you.
Good. Thank you, lawyer, accountant, taxman, banker, economist. Thank you so much. That
You're
was
most welcome.
really good. I was just watching and just absorbing and writing notes, and I'm sure that already I've seen so many comments coming up. So take some breath, and we'll come back to you as we go through the comments. I'm sure it's going to be a lot of discussion because I've seen some great comments
That is
already.
good.
All right. So thank you so much,
You're most
Dr.
welcome.
Abdallah, for those great insights into tax law. And as I said from the beginning, taxation is a really big subject. And so many of us try to avoid it. But as leaders, we need to understand some of these things so that we can run our businesses well. We can encourage our employees, because some of the things he said, you see, you can even help your employees minimize their taxes and therefore increase their take-home pay, so they don't come and fight for more pay. So thank you so much. Right. Okay. So quickly, let's see who is in the house. Miss Abby is in the house. Isaac Asian is in the house. Jimama Tiekubia Jemfi is in the house. And Ebenezer Niama is here in the house. We have Kowo is in the house. Samuel Ehiave is here, all the way from Suhum. Nada Mafo is here from Accra. Ebenezer Tufo is here from Abuja. All right, go say he's Philip. So Philip, you're welcome. Patrick Owusu is here from Accra. Thank you so much. And Teresa Asarikuma is here. Gerard Foucault, thanks for coming. Accra. Chalinete is here from Gumuafete. Thanks for coming. Kwame JB is here from UK. Thank you. This is one of the certainties of life is tax. Okay. All right. Dennis Ahe is here. Good evening to everyone. Emmanuel Wulo Willendall is here. Great learnings, he says. Shadrach Gousu says, insightful presentation. Thank you so much. Joshua Sintim says, thank you, Doc. God bless you. Please, landlord pay property rate. Should that be enough, or they should pay taxes from the income they receive from tenants? So, Doc, that's the first question coming up from Joseph Osesintim. He's asking, please just note it. We'll come back to you. So as a landlord, you've paid property rate and you have received your rent. Should you pay a gain tax on that rent? Jemima Tiekubia Jemfi is saying, Doc, it looks like we are paying double tax because VAT is charged on the GET Fund, NIL, and COVID levy. So, Doc, you want to please explain that a bit to us? Okay, so that's the question number 2 for Doc. And Nada goes on to say, so all the other taxes are added to the net value of the invoice before VAT is charged. Is this not tax on tax? All right, so he's explaining her question. So that's a good question there. Collins Lucerium Nye says tax evasion and tax avoidance, which of them is a crime? I think Doc has explained that. Another ask again. All right, so maybe we should take, after this another question, maybe Doc would answer some of the questions and then we can continue the other comments. Nada's next question is, what is the maximum period goods can be held in a bonded warehouse. So, Doc, there are, I think, 3 questions up there, and if you've noted them, we'll come back to you in a minute when Kofi shares with our participants our running growth journey program, where we are encouraging you to grow as leaders. And we have a 15-week accelerator growth journey. We are running the 3rd cohort now, and we are building up for the 4th one. So please register before it gets full. Kofi, let's go with a show, and then Doc will come and answer those questions for us. All right. It looks like Kofi is having an issue. So, Doc, please go ahead and address those questions, and then we'll come back to the other questions. Thank you so much.
Okay. Thank you very much. The first question had to do with whether landlords, after paying property rate, are required to pay rent tax. Yes, the property rate is on the location of your property and the value of it. So usually what happens is that is a payment to the assembly where your property is. And so they value the property and they have what they call the rates that are applied on the rateable value, and then your property rate is determined. It's ideally for the assembly, for the upkeep of the environment where you are, cleaning of the gutters, provision of sanitation, and all those. So that is on the property and where it is situated and based on its value, although they've not been upgraded in a while, I believe, for some assemblies. But the rent is income that you have earned by letting out your property to another for a fee. And so that is an income you have earned for which you need to pay a fair share to government. On the double tax, yes, I would agree with you. It is a tax on a tax, but that is a significant feature of indirect taxes. In indirect taxation, we don't refer to it as double tax. We call it the cascading effect of tax. That is a tax upon a tax. So yes, charging the straight levies, that is the Get Fund, National Health Insurance, COVID levy on the fee, and then adding it before applying the VAT is a cascading effect of tax. But as I indicated, it's a feature of indirect taxation, and there is no rule of international law against cascading effect of tax. Reason being that if it comes to double taxation, even unless the country has entered into a double taxation agreement with another country for the avoidance of double taxation, you always suffer double taxation. And so you find out that this is even not the only area where we have the cascading effect. When it comes to the communication service tax, it's the same, because the communication service tax is charged on the cost that you make, data you use, plus the VAT and all that. If you even import, paying is on the duty inclusive value. So it is the value of the goods, that's the CIF, cost insurance freight, and then they charge the import duty. If it's 20%, is added before the VAT is calculated. So there too, there is cascading effect of tax. So it's not a feature that is not known. It's common. The problem is that it leads to high costs of items, which could possibly lead to inflation. And so it is normally discouraged, but it's explained away. So yes, it is a tax on a tax. Then, as I indicated, tax evasion is a crime, and so not acceptable. And then tax avoidance, although you are doing it in accordance with the law, there is the need for care, because you can cross the line and end up evading, especially when you are caught in aggressive tax avoidance, taking advantage of incentives and benefits that you weren't entitled to. Then you fall into evasion. On the maximum period goods can be held in a bonded warehouse, I think that it all borders on if the goods, it matters whether the goods are perishable or not perishable. It's very significant. So You wouldn't have a standard number of days that will be required. But of course, it's all based on what the law has provided, and then your discussion. The customs division has a whole unit on bonded warehousing, and they have their agreements and arrangements that they sometimes would have to give way and accept for some importers. So I think that it depends on the commodity involved. Thank you very much.
Thank you so much, Doc.
Most welcome.
Straightforward answers, clear. Next, Derek Ohini Jemfi is also in the room, and he has a few questions to ask. He says, my startup partnership took an equipment on hire purchase for business. I was told I had to pay taxes on the profit that I was using to pay off the equipment, even when I've not finished paying. So, Doc, a bit of an interesting scenario there. He's taking an equipment on hire purchase. He hasn't finished paying. He's been asked to pay taxes, and he doesn't understand why he has to pay taxes on equipment he hasn't finished paying. How do we assess this tax? He's happy with the training. He says good training program, especially for startups. We have Dorothea Thompson is also in the house. I have Teresa Sarikuma in the house. Shadrach is grateful. Conrad, says this is enlightening. Thanks for the information. Ebenezer Niyama says great delivery, very detailed. All right. Gabriel Etonam says she blessed to take part in this great teaching. All right. So upon Yao, Issa Gilbert is here in the house. Gabriel says he's from Volta region. All right. I'm not seeing any question. Daniel Opon is in the house also. Opon Yina says great presentation. Benedicta Daxon says powerful presentation, Doc. It's a privilege listening to you always. All right. We all love Doc. Reda Mills, very insightful. Thank you, Doc. All right. So Collins, should redundancy entitlement be subject to tax? That's the second question, Doc, here. Redundancy entitlement, should it be subject to tax? Nihan Sinoti, should I pay WHT on per diem in lieu of accommodation, meals, and incidents and inconvenience? Doc, WHT. What is WHT? I mean,
withholding tax.
Oh, withholding tax. Okay,
yes.
Okay. All right. So she did pay withholding tax on per diems in lieu of accommodation, meals, and incidentals. I'm not sure that would be a service. All right. So that's your second question or third. I don't know.
Third.
Enoch Esiama says a 16-year-old lady refused to pay tax when visited by GRA officials. Her reason was that she is less than 18 years. Is there a year limit for one to pay taxes? This is an interesting one. All right. Let's see. Okay, we have some time. Okay, so Doc, take those ones. I don't want to.
Okay.
Well, take those
No
ones.
problem.
You come in, and so over to you, Doc.
Thank you very much. Before I answer these questions, I think that when I answered the question on the goods to be kept in the bonded warehouse, I think maybe the person wanted the exact period. Maybe my answer was too general. But as I indicated, it depends on the goods. So if they are raw materials, you have up to about 2 years, 6 months, because raw materials, of course, are for construction, manufacturing, and what have you. If they are general goods, you have 1 year, 6 months. And then if they are perishable goods, you have 6 months. So that can be a guide for you. 6 months for perishable goods, 1 year, 6 months for general goods, and then 2 years, 6 months for raw materials. Now, on Derry's question on high purchase, is the explanation was not too clear, but let me hazard a direction. If you rented the equipment for use on high purchase, as you are paying the lease rental, it is an expense you are incurring in using the asset. The payment you are making is an income to the owner of the equipment. He is to disclose that as income and pay tax. At your end, it is an expense, but you are required to withhold tax on the lease payment because it is income to that person and you are required to withhold tax. And if he was supplying you the goods, because it's high purchase, you are hiring it for now, making installment payment to own it at the end of the payment of the agreed sum, then it will be good. So 3% withholding. So if you are saying they ask that you pay taxes on the equipment, I believe it is the acquisition and the withholding pay could be what is being discussed here.
Doc, I
Yes.
think what he's saying is that he's
Mhm.
using it for business.
Yes.
So maybe, for example, he's bought a trotro
Okay.
and he's bought it on high purchase, but he's
Yes.
using it for trotro,
Yes.
and then the money's coming in from the trotro. He's been
Yes.
asked to pay tax on it, but he hasn't finished paying for the trotro
Oh,
car.
yes, but
So,
that is income you are earning, and the payment you make for paying for the trotro is an expense. So you will be deducting the lease payments from your income. The net is your profit, and that is a share of which the taxman is asking for. So I don't think it is. Ideally, you may think that as startups, and that is what we have in our law, all businesses have automatic 3 years carry forward of losses. The idea was, can we look at a holiday for startups? But it used to be there, and there was the challenge of abuse. Because after the 3 years that the business has established and he has to pay tax, he either goes underground or change the name or starts another one. And so these are the challenges we're trying to assist the startups. But it's a good idea we start thinking about how to assist such startups to cover their cost and then be profitable, and then we can get our share of the profit. In most jurisdictions, they have various ways of assisting in that manner. Then on whether redundancy entitlement is taxable. No, if you take the Income Tax Act, it is clear that redundancy is exempt from tax, redundancy payment. This I call the human rights aspect of the tax law. You've lost your job, and the money being given to you is to assist you to survive whilst you look for another job. And so it becomes a little bit harsh to try to tax it. So I call it one of the human rights provisions in the tax law. So you can see the tax law is not that bad, always chasing people. It's also sensitive to situations like redundancy payments. Then on per diem, whether it's subject to withholding tax in lieu of accommodation. The challenge is this. With per diem, we know that we have two types. Some per diem are given and they are accountable. So if you paid accommodation, of course, you would come and account for the per diem with the receipts of the hotel or wherever you stayed. And then that would be used to retire the amount given to you. But where it is not accountable, then of course it is income coming to your hands. And so we need to know what was the nature of the per diem. If it was accountable, of course, once you can bring all the documents to show how you spent that money, then they can retire it. It will not be on you. But if it
no,
is,
no, this
yeah,
one was in lieu. This one, the way you said it is in lieu of the accommodation. So
yes.
he's
So if
going
you
there.
are going, let's say you are going on a trek or assignment and you've been given the money for the accommodation, they cannot withhold.
Yes,
That is what I'm explaining, because you have a
yes.
come and retire that per diem with the receipt. So they cannot withhold that payment. But we have situations where you are giving the money in lieu of accommodation. You arrive at the place and you go put up with a friend or a relation. So you see, how do you account for that money? If you are not able to account for it, then of course it went to you as an income and the withholding would follow. So that is why I was trying to explain the nature of a year. Then how a 16-year-old failing to pay tax on account of age. Interestingly, when it comes to taxation, age is not the issue, because indeed, even where you have underage persons, with the administrator or the administrator or any other person taking care of that underage, if any property is in the name of that person, of course, you are in a dual taxable entity. You need to assess and pay taxes that are due to the infant. So for me, at the 16 years, the law is only saying that if you have earned income from business, employment, or investment, you need to pay tax. It doesn't look at age. Age comes in a lot of our laws when it gets to marriage or when it gets to looking for a job. When we say at the age of 18, you may be put in learning a trade. But when it comes to taxation, what happens if you are 10 years old and your father has built a house and the rent is being paid to you as the 10-year-old? That is what your dad has left for you. You are earning income. So we need to look at who is managing that fund for you. So if you are at 16 and you are earning income, then of course, depending on the type of income, the appropriate tax is due.
Thank you so much. And as anticipated, this subject is attracting so many questions. So, I mean, we're going to 8:30, guys. So after 8:30, we will see if Doc has some time. If he doesn't, then we will close. Your question doesn't come in before 8:30, then that will be it. But let's see as how fast we can go. Upon Yao is asking, if an employer pays rent to a landlord, an employer pays rent to a landlord for an employee, is the employer supposed to withhold tax, or the landlord should be the one to do so? Okay, so that is first question. Second question from Mamaga Yairana says, it is even the consumers who are paying the VAT and not the entity. So it's not double taxation in the first place. Well, maybe you want to comment on that. Is a consumer is being paid made to pay twice on the, so it's the same incidence. Okay, Collins is asking, why does a withdrawal on a provident fund before the 10 years of vesting period be subject to 15% tax? So that's a question on provident fund withdrawal. Wheezy is in the house. Afresechi is in the house. He says, great presentations as always. Charles says, good delivery. Hope Amiel says, why is GRA reluctant in collecting rent tax? For years, the law has been reluctant for CRA. Okay. All right. So why is GRA reluctant to collect taxes on rent? Ali Mohammed from Techima, he says, brilliant presentation. Sir Mami says, wow, thank you, Doc, for the presentation. All right. Nehansen says, non-accountable per diem. So that was his question. Thank you, Doc. All right. So I guess there should be one last question. Daniel Pons says, why can't we tax interest on soft financial investment for individual? Why can't we tax interest on soft financial investment for individuals? The gifts people receive and do not pay taxes all end up in soft financial investments. Not sure if I get that one, but maybe
Okay.
doctors.
Okay.
Not very clear to me
Mm.
too. All right. Last one
Mhm.
is ex gratia taxable in general, and at what rate? At the assembly level, is ex gratia for assembly members taxable, and also at what rate? Okay, so those are the last questions.
Mhm.
Gabriel says, great delivery, an eye opener. All right. Okay.
Mm.
And
Okay.
Joel is in the house. So, Doc,
Okay. Thank
um,
you very much. I will start with Mr. Pong.
yes,
Employer pays rent to the landlord. Yes. So normally, when the employer is renting the facility for the employee, the agreement is normally entered into between the employer and the landlord, and that is why it's the employer that has to withhold. And talking about withholding tax on rent, let's be mindful individuals cannot withhold. So, you and I going to rent a house, we cannot withhold. But if we are renting it for business purposes, let's say Ali Nakyea Enterprise, then of course I can withhold. And the idea is that tracing and tracking the compliance and whether after withholding the individual will pay to the GRA is easier with recognized entities like companies, partnerships,
yeah,
embassies, high commissions, and NGOs rather than individuals. So if it is the employer, he would withhold. And Mamaga mentioned that the consumers are paying the VAT, so it's not double tax. Yes, that is why we said that if it comes to indirect tax, it is better known as cascading tax rather than double tax. Because as Mamaga understands, the double taxation is paying tax on the same income twice by the same person. So once the VAT is an indirect tax, obviously you can relate double taxation to it. You can use it loosely, but the proper term is that it has led to a cascading effect of tax, meaning there is a tax upon a tax. Collins is wondering why the withdrawal of Provident Fund. Yes, the issue is that contributions to the Provident Fund have been allowed as a deduction and not taxed in the hands of the contributor. And that is why the period has been given. And so anytime you have to withdraw before the period, then it is thought of that you weren't doing a provident fund, which is why the tax now would come on you. So it's kind of a back tax. So if the vesting period is not up and you withdraw, remember when you were contributing, it wasn't taxed. So if you can't wait for the 10 years, then of course you have to pay the tax on it. That is the essence. Ideally, like I indicated, tax is not only about raising revenue. Remember the last point we mentioned about guiding or influencing behavior. So the idea is to influence behavior of contributors not to access the money until after 10 years. So you can have a pool of funds. Because remember, the Provident Fund managers are also investing it for gains for you. And so if you tamper with it before the period, it affects the earning streams. Then, Boss, I wanted to know why, okay, why GRA has not been collecting rent tax all this while, because that is the challenge we have when taxes are based more like on self-assessment. It is thought of that we all would be tax compliant and responsive to this basic civic duty, because I believe the first civic duty of a citizen is to pay your taxes. It is a challenge that people complain we don't see what the tax money is being used for. Others are benefiting in so many ways we may not know or benefit. For example, if hospitals are put up, we may not be getting sick, but remember, those getting sick are getting catered for in the hospitals. It's just like insurance. You'll be paying insurance, you don't ever get involved in an accident, but people are claiming premiums. Even day one that they did insurance, they got involved in an accident. So I think that as citizens, if we all are up and doing with our taxes, we may even be more prone to having a deeper voice to call on government to provide for us rather than that. So I think it's a good call that my good friend Mr. Mia has mentioned. And if you follow the press, I think the Commissioner General has already published that all landlords should be on the lookout as revenue officers are going around taking data and following up to know those who have complied and those who have not complied. So it's better late than never. I think it has started. Then Mr. Danopon was wondering why we can't tax interest on soft loans or something. It wasn't too clear, but interest, I told you there is withholding tax of 8% on interest payment. So whoever is giving out loans, when the interest is being paid, there is a withholding tax on it. And remember, for withholding tax also, taxpayers can apply to the Commissioner General for an exemption from withholding tax. And this, you must meet certain criteria. You must show that you've been compliant with the tax law. You've been filing your tax returns. If you're an employer, as a business leader, you've been filing your director's returns. You've been complying with withholding tax rules. And you should have been audited by the GRA in not less than the 3 years before your application. That is, if you've been in business for more than that. And then if you meet this criteria, the Commissioner General can give you a letter showing anybody paying you should not withhold. So where a lot of such businesses provide that exemption letter, then you are not under obligation to withhold. Then there was the last question, whether ex gratia is taxable. Yes, ex gratia is taxable because if you take the Income Tax Act 2015, Act 896, specifically, you can go to Section 4, Subsection 3. It is clearly stated there. Section 4, Subsection 3, Paragraph C says that any payment, benefits by way of amount given to a person for past, present, or prospective employment is taxable. And ex gratia is being given to you for your past employment. So ex gratia is taxable, and the assemblemen being paid the ex gratia are to pay the tax. There is no specific rate for the taxing of ex gratia. It is added to the person's salary and subjected to the graduated tax rate. So yes, ex gratia is taxable. Thank you very much.
Thank you so much, Doc. Thank you so very much. There are a few more comments, but we're crossing the hour, so we are going to, Doc is going to just wrap up with us if Kofi is ready. If he's not ready, I just want to inform all of you on the platform that we have our growth journey running. The growth journey is 15 weeks of coaching to help you elevate your level of growth as a leader, to grow personally in different dimensions. And it's very, very discussional. It's an exchange. At the end of it, you have a growth plan for your life, for your career, and for your leadership. So we encourage all of you. We've had great discussions on the growth journey. We've had first 3 sessions. The third one is on, but we also running we've opened for the 4th cohort. So please register. We need 15 people. It's only 15 people on each journey. So the earlier you register, the better, because once it's full, then we move on to the next cohort. Thank you so very much. I don't know if Sarah has any comment. Sarah, if you have any comment or question, otherwise we would give room to Prof to give us his closing remarks. Sarah, any question, comment for Doc?
Yeah, so I think he has answered most of the questions. So after taking those answers, and time is fast spent, so I just want to respect Doc's time and the viewers' time. So Doc, over to you. Thank you.
Thank you. Most grateful.
All right. Thank you so much, Sarah. Doc, give us your closing remarks.
My closing remarks are just to say a big thank you to the leadership platform for this opportunity to share knowledge and to help leaders to be up and doing with their taxes. As the saying goes by Justice Oliver Wendell Holmes, who mentioned that taxes are what we pay for a civilized society. So once we are up and doing with our taxes, government does not do business. Government's main source of revenue is taxes, and that is what is used to develop an economy. And also, we also remember that in tax planning, we are not saying we wouldn't pay tax, but we don't wish to pay more than is due. We save whatever taxes we shouldn't have paid. We don't spend it. We use it to invest in businesses and continue to grow our businesses and create jobs. So I would leave you with a saying and also the advice that anytime you have issues with the revenue, you can approach the revenue office where you file your taxes for guidance and assistance. You can make use of auditors, chartered accountants. We have chartered tax consultants and all the advisors who can guide you, because preventing yourself from tax exposures and penalties and interest go a long way to help your businesses grow. Because if you have to grow ethically and responsibly. Thank you very much for your attention, and God bless us all.
Thank you so much, Doc, and God bless you. And by the way, if you want tax advice for your business, you can always reach out to Doc and his firm. They will help you with tax advice and consulting. So on that note, I want to thank all of you for your engagement on the platform. And we encourage you to share the link to your friends, to your other colleagues, and also make a date with us next week when we come your way again with another great leader and another great topic. This has been the Leadership Platform, and my name is Samuel Ayim. I want to thank all of you. God bless you, and have a very good night. Bye-bye.
Thank you.
Hi, dear friend. My name is Samuel Ayim, and I'm the CEO for the Center for Transformational Leadership. And I'm bringing to you the growth journey. We've set aside 15 weeks of growth to help you to be intentional about your growth. Where do you want to reach in your leadership? Which area of your life do you want to grow in? Growth doesn't just happen. It has to be intentional. So in these 15 weeks, we're going to have a special coaching sessions with you to be able to grow to where you want to grow. And to be able to grow yourself, you need to know yourself. A lot of us are not achieving the maximum we can achieve because we have not invested in our personal growth. We're going to help you in all and more within these 15 weeks. Every week we'll have a session with you. This program is limited to only 15 people. We're going to have 15 people for 15 weeks, and we're going to learn 15 great growth lessons on this journey. So make a date with us and see you on the growth journey.